from say 1968 to 2020, we were in a unipolar world where the United States was a key, strong government in the world, and we had a lot of allies. We didn't have that many enemies, and the currency was really kind of a dominant currency. Whereas in a multipolar world, because of interest as a percentage of interest next year, it's going to be almost right now, interest rates are here. Interest rates are going to be over $1 trillion, maybe $1.2 trillion. So the budget, the military budget, the U.S.'s ability to be the world's policeman, all that's kind of like dissipating a little bit. At the same time, we've got two wars. One in, obviously, this is classic multipolar. One in Ukraine, other one in the Middle East, and the tragedy in Israel. So wars are extremely inflationary. Wars, they basically, the trading routes, once they get a little bit complicated, it sets up where supply chains have to be backed up. And then governments like the United States, we just wrote the Ukraine a well over $100 billion check. And guess what? For Israel and what that country is going through and the type of ally, you can't write the Ukraine $100 billion check without opening up the checkbook for, say, Israel in wartime. So to fund wars, it's extremely expensive. All this creates just a whole, on top of everything else that's going on in the United States around power of labor unions, inflation. It just creates a multipolar world, creates more inflationary trends, higher bond yields, and that creates a whole new, really kind of investment thesis for families that are looking at their money. The Fed's trying to fight inflation, and they've been aggressive with rate hikes. In recent months, they've slowed it down, but they're using their vocal cords very aggressively. So they're saying, okay, we're going to hike 2 more times. We're going to go to 6, maybe 6.5%. But the problem is they're breaking Bank of America really into almost insolvency. Companies like Bank of America that own lots of bonds, those bonds are now down 10, 15, 20 points. And so the banks are stressed. At the same time, we have this massive stress in the Middle East. We have a government shutdown potentially for November 5th, 17th. So if you're Powell, you're in a very difficult spot because you've got this crisis in the Middle East, which that geopolitical tension is very difficult to raise interest rates into that. You've got no House Speaker and really a budget shutdown on November 17th. And at the same time, you have Bank of America and Citi that are extremely stressed from these rate hikes. And you can see it by the credit default swaps, the bets, some people are making bets on the credit default swaps. So those three things are going to stop the Fed. The Fed is done, and they probably hike rate. They probably cut rates by 100 basis points by next July. When you use sanctions, you should use them. They're great weapons, but they have diminishing returns. So it's a weapon that should be used once, twice a decade, right? Unfortunately, they've been using this weapon, I think almost every year to multiple countries. So you're using it against Russia, Venezuela, you're using it against Libya. You've used these weapons of sanctions against so many different countries. And the more you do that, first of all, the entire emerging market community has a back end game around the sanctions. And you can see it in the commodity market. There's ways to get around sanctions. And so the sanctions have diminishing returns over time. They also push capital away from the dollar into another, type of currency regime that's outside the dollar regime. And you can see that with say in China, the amount of China imports that are in yuan, that number is going up a lot. And so I'm not saying the dollar is going to lose its reserve currency status anytime soon, but the propensity to move capital away from dollars is very high. And that, is another problem for next year with the dollar, because if the Fed's done hiking rates and at the same time the Treasury is using these sanctions again and again and again on multiple different countries, it just creates a whole backdrop where a lot of investors in the world, like Saudi Arabia, maybe they buy less treasuries, or there's just different countries in the world that China, for example, buying less treasuries. So the sanction game is a very, very dangerous game. It's an overused tool. If China had, if 80% of China's GDP came from the internal workings of the economy, they could make a move on Taiwan. But there's still an export-based economy to a large extent. And so if they were to make any kind of move on Taiwan, the economy would be crippled because Chinese products would be boycotted. And so I just don't see it. But in terms of, World War III, it's when you take Nike, one of my old bosses at Lehman said, when you take nitroglycerin and you put it next to dynamite, you're creating bad. It's a very, very bad risk setup. And so it's very dangerous to have these conflicts, especially in the Middle East, Ukraine. They can easily spill into wider conflicts. And so, yeah, I don't think the S&P at 20 times earnings is priced anywhere near for that world. If you look back historically, when you're in a higher interest rate regime, higher geopolitical, higher multipolar world, that's stressed, stocks should be trading at 12 to 15 times earnings, not 18 and a half to 20 times earnings. In the case of the FANGs, 25 to 30 times earnings. So, and if you look at it, the utilities are in flames, the staples, like your classic hideouts, your classic world-class investing hideouts in the United States, your consumer staples and your utilities, both of those sectors are in a lot of pressure. And a lot of that movie is now, that capital is now hiding out in the FANG stocks, your Facebooks, your Apples, your Amazons. So it's a very dangerous setup, very dangerous.